question. This is consolidated statement of comprehensive income. The question is taken from September 2020 exam. Let me start reading it very quickly. We have few notes, and it says that Alpha, a parent company with one subsidiary Beta, so we already know it's a subsidiary, is preparing the consolidated statement of profit or loss and other comprehensive income. So it means statement of comprehensive income we need to prepare for the year ending 31st March 2005. The draft statement of profit or loss and other comprehensive income are as follows. I don't think something wrong with this pen. It is doing some problem. Let me use it from here. So revenue for Alpha, Beta, cost of sale, gross profit, distribution, expenses, etc. And they have given us note 2 for revenue, note 2 and 4 for cost of sale. There is no note here. And then investment income, note 1 and note 3. Finance cost is note 1. And you get to your profit before tax, tax expense, profit for the year, other comprehensive income, gain on property revaluation, note number 4, other comprehensive income, and then total comprehensive income DCI. So let's start reading this. By the way, now we are doing this comprehensive income. First working, you need to do working. Now here you don't do working for goodwill and non-controlling interest and fair value adjustments and unrealized profits. Unrealized profit we will do, by the way. So I mean the workings are different. Here we start with, like, if you remember that in balance sheet, first you make net assets of subsidiary at acquisition date, net assets of subsidiary at reporting date. That was our main working to begin with when we were doing balance sheet. In income statement, we start with revenue, like the line items. The first working always is the revenue. Logically speaking, the second working should be cost of sale. But many times we do cost of sale working a little below because there are some adjustments or some workings or some numbers which we need to calculate before in order to prepare your cost of sale working. Like if you see the format, cost of sale is the second line. But when you start making your workings, cost of sale will be a little bit down because there are usually some other adjustments affecting the cost of sale. So we need to do those workings and then we come to cost of sale. And then we prepare a working for each of this item. We make a working here, we make working here, we do working for investment income, we do working for finance cost, we need to calculate gain on revaluation working. All these will require one separate working. Anyways, let's start with this. On 1st April 2003, Alpha acquired 180 million equity shares in Beta. On that date, Beta had 200 million equity shares. So one thing is clear that Alpha is acquiring 90% of Beta and non-controlling interest is only 10%. Alpha made a cash payment of 60 million to the former shareholders of Beta on 1st April and agreed to make a further payment of 26.62 million on 31st March 2006. This is 2003, 2004, 2005, and 2006. So 3 years deferred payment. We need to find out the present value of this deferred payment, and then we will unwind, and the finance cost will be included into the finance cost. So you understand that 26.62 million has to be paid after 3 years. So we need to find out its present value. Alpha had correctly accounted for the deferred payment in its financial statement for the year ended 31st March 2004. Okay. The question requires us prepare the consolidated statement of profit and loss and other comprehensive income of Alpha for the year ended 31st March 2005. 31st March 2005. And here they tell us that they acquired it on 1st April 2003. So you are preparing 2004, 2005. After 2 years, you are preparing. So in the first year, at the end of year 1, they had correctly accounted for the deferred payment in 31st March 2004, but has made no further entries in its financial statements for the year ended 31st March 2005. So what should go to 31st March 2005? The finance cost for the second year. So it looks like that they did calculate the present value and they did calculate the unwinding of that present value and calculate the finance cost and charge it to the first year, which was 2004 ending. But the second year ending 2005, they did not include that finance cost because it says had made no further entries. So we need to do it. And discounting calculations are done at 10%. The present value of $1 payable in 3 years is 0.7513. So this is the discount factor. We are going to discount this 26.62 million. So 26.62 multiplied by 0.7513 will give us the present value, and then we will unwind to do the finance cost. On 31st December 2004, Beta paid a dividend of 5 million. This was the only dividend paid by Beta in the year ended 31st March 2005 because they are paying in 31st December 2004. It lies within 2005 year, which we are preparing, and this is the only dividend and was appropriately recognized by Alpha. So it means Alpha is showing somewhere in their financial statements investment income. So you might have some here investment income here 7 million. So out of the 7 million, 5 million is coming in from Beta. So this is intragroup dividend. We have to eliminate this thing. So this 7 million, we will decrease this 5 million. We will deduct this 5 million from here because it's intragroup dividend. On 1st April 2003, like on the acquisition date, Alpha made a long-term loan to Beta of 25 million. The loans are included in the financial statements of Beta at this amount. These long-term loans attract interest at an annual rate of 8%. Both Alpha and Beta have correctly accounted for this interest in their individual financial statements for the year ended 31st March 2005. 25 million into 8%. This was the interest paid by the subsidiary to the parent, and they both accounted for. So 25 million into 8%, it makes, I think, 2 million. 2 million. So 2 million of interest is recorded as finance income by Alpha and finance cost by Beta. So that 2 million actually is shown here inside of Beta and inside of Alpha. So it means that this 7 million of investment income, this is all coming in from intragroup activity because 7 million includes 5 million of, no, not 5 million, because 5 million was the total dividend paid. Alpha did not get 5 million because Alpha owns 90%, to times 0.9. So actually inside of the 7 million, 4.5 million is the dividend, which has been received by Alpha from Beta, so we need to deduct it, and 2 million was the intragroup interest. So actually the investment income remains only 500. This is 500, which Alpha might have earned from other sources. So you need to understand, as you are reading these notes, you need to keep, start making a picture in your mind what I'm going to do. So intragroup interest I have to remove. No impairment of the goodwill on acquisition of Beta have been evident up to and including 31st March 2005. Thank you very much. Life is easy. Goodwill is not there. Then there is intragroup trading. Alpha supplies Beta with a raw material which it uses in its production process. Alpha applies a markup of 1/3 of its cost. 1/3 of its cost. Okay. So 1/3 of the cost, and 2/3 is there. Okay. Sales of the raw material by Alpha to Beta in the year ended in 31st March 2005 totaled 10 million. During the year, 10 million were the sales. Let me try if my pen works now. It has started giving me some trouble. That's good. So in this year, 10 million were sales. On 31st March 2004 and 2005, the inventories of Beta included goods costing 2 million and 3 million. So here there was there was an intragroup inventory from intragroup sale of 2 million. And again, there's an inventory here. Now, this is a question which is giving me or telling us a little bit, you have to learn a new thing. Before, you always had the closing inventory left over from intragroup sales, and you have unrealized profit at the end of the year. But this time, there is an opening inventory as well, because they're telling you that there are both inventories, beginning of the year and end of the year. Both time you have inventory. So what you need to do, either you take a difference, you will say that actually the closing inventory should be taken as only 1 million, because 2 million was already treated in the last year. If you see that the total closing inventory is 3 million from intragroup sale, but out of this 3 million, 2 million was the opening inventory, which means that this was the closing last year. So it means that this had already been accounted in the previous year. So in this year, I only need to calculate the unrealized profit on 1 million. This is something you need to learn. If there is no opening inventory, then you will calculate unrealized profit on 3 million. But because there is opening inventory, we need to make adjustment for that. And 1/3 is the profit. Alpha's other investments, apart from its investments in the equity share, by the way, I'm reading all of the notes except this equity share, share-based payment IFRS 2. Although we can start doing now, but I just want to make sure that we don't leave it something. Alpha's other investment. Apart from its investment in the equity shares and loans of Beta, so Alpha is invested in the equity share and loans of Beta, it has some other as well. Alpha has a portfolio of equity investments which are correctly classified as fair value through P&L. The investment income of Alpha for the year ended 31st March, which was 7 million, 2005, correctly includes dividend income from this portfolio. Remember that 500,000 remaining balance. However, the carrying amount of the portfolio has not been adjusted to its fair value at 31st March 2005. On 31st March, the carrying amount of the portfolio was 32 million and the fair value is 33.5 million. So they actually, in this, remember the 7 million we mentioned? The 7 million was investment income. And this investment income is coming in from investment in Beta plus others. So we understood that we have to eliminate these two things. But then it tells us that, and this actually 500 is coming from other investments. This 500, which is remaining balance, it comes from other investment. But it says that this was included, but there is an adjustment here because there is a gain on this fair value revaluation. And that gain is 1.5 million. So we need to include 1.5 million into our P&L because it is fair value through P&L. And 1.5 million of change in the fair value, that gain should be recorded in P&L, which they did not record. So 500 plus I will do 1.5 million, which means 1500. So 2 million I will take here total in my consolidated in P&L. Revaluation of property, plant, and equipment. Both Alpha and Beta measure their PPE using the revaluation model. PPE is remeasured at the end of each financial year. In previous periods, Alpha had recorded net revaluation losses of 3.5 million. Okay. These losses were correctly accounted for under the requirement of IS 16 PPE. So, in the financial statements of Alpha for the year ended 31st March, remeasurement gain of 5 million were entirely recognized in other comprehensive income. Entirely recognized. Let's go back and see the financial statement. What do they have in other comprehensive income? So, actually, revaluation gain are made. Alpha made 5 million, Beta made 3 million. A total of 8 million is there. Total of 8 million is there, but 3.5 million they charged previously. It says that Alpha and Beta both measure PP using the revaluation model. PP is measured at the end of each financial year. In the previous periods, Alpha had recorded net revaluation losses of 3.5 million. They charged 3.5 million before, okay, and now they're making a revaluation gain. So you know that it goes to statement of comprehensive income, SOCI, but some part which was charged to P&L before, that much of gain you should transfer to P&L. So I mean, the total is 8 million. The total is 8 million. 5 plus 3, the total makes 8 million. But all of that 8 million should not go to SOCI, because if you had recorded some losses before in P&L, then you should go back and make a reversal in P&L, make a credit to the cost there. Okay, anyways, let's read it later. It says that in the financial statements of Alpha for the year 31st March 2005, remeasurement gains 5 million were entirely recognized in OCI, not a correct treatment. These gains related to the same properties which had previously suffered revaluation losses. So we need to make adjustment of the past losses first. Beta has only ever recorded revaluation gains. All depreciation and impairment of PPE are recognized in the cost of sale. This is actually impairment. When it says revaluation losses they made, revaluation loss means impairment. So impairment and depreciation goes to cost of sales. So this impact we need to reverse back, not in admin expenses, because what happens that if you have depreciation and impairment of administrative assets, you took it into admin expenses, like here. In admin expenses, you show your depreciation and impairment, which are related to administrative assets. But if you have depreciation and impairment of production related assets, they are charged to cost of sales, because cost of sale is actually the production related cost. So therefore, cost of sale includes the depreciation and impairment of plant and equipment, machinery, etc. And this is what they are doing as well, because they did not tell us that what PPE it is. I mean, when it says that PPE, I was actually thinking that what is it exactly? Is it plant and equipment, or is it land and building? What it is? So I didn't know that. Should I take it to cost of sale or should I take it to admin expenses? But now when it says that they charge it to cost of sale, so it looks like that this PPE is production related. So if we need to make some reversal of 3.5 million before they made a loss, now there is a gain. So I need to remove or recover that loss in my P&L, but I will recover it in the cost of sale part. Then equity settled share-based payments, I think I should do it later, because generally it has got nothing to do with my revenue or with my cost of sale, with my other things. Yeah, it might go into my admin expenses because there will be some, staff cost. So admin expenses, when I will calculate it. Let's start calculating our workings. If you've got any question, please ask me. So working number 1 should be, actually I should make this one a little smaller. This is slightly bigger. This one even bigger, so that we can show our workings here, and the final numbers will be here. So working 1 should be always for revenue. I can put like this, and Alpha's revenue, and Beta's revenue, and I would say, less intragroup revenue. So Alpha revenue is given to us straight as 64,800. Beta revenue is 39, And intra-group revenue, if I'm not mistaken, it was 10 million. Let me confirm here, intra-group trading during the year was 10 million. So I'll subtract 10 million from here and I'll put it like this. And let me put like 3 zeros on the top so that we understand that it's in millions, okay? So we take it this one number as. So you get half a number, half a mark for this here. You call it, group revenue or consolidated revenue, whatever. So this number is done. Logically, I mean, in sequence, the second working is cost of sale, but I'm not going to do cost of sale working before because I know that cost of sale working will require some other items as well. So I'll go with some other workings before doing the cost of sale thing. For example, I'll straight jump down here. To administrative expenses because I remember that there was some note given to administrative. And by the way, finance cost also we need to do because there was some. Let me do deferred consideration first because that was very clear. Deferred consideration. Let me take finance cost even down because this came first in the sequence when I was reading the question. I know deferred consideration was 26 million something, and they gave us the discount factor as well, 26.62 million, and the discount factor was 7.513, 0.7513. So I'll take it 26.620. So 26,620 into 0.7513. So this is my deferred consideration. Let me call it present value of deferred consideration. Let me just increase this thing and we put here. And we'll say that finance cost until 31st of March 2004, year one, because they told us that in year one they charged it correctly, which was 10%, and that should be this into 10% full 1 year. And I make a total of this, it makes me 22 million or something. Let me just arrange these numbers. So 22 million was there. So I'll call it balance on 01, 04, 2005, and then I would say finance cost for 2005. This is what we need. Second year finance cost they did not include. If you see here, it said that made no further entries in its financial statements for the year ended 31st March 2005. So the second year finance cost was not included. So that again is 10%, and that I'm going to use it in my finance cost, 2.2 million. If you are making the balance sheet, then this should be your closing balance. Okay, you should say that closing balance at 31st March 2005. We are not making balance sheet, so we don't need this number, by the way. This 2420, we don't need it. But otherwise, we should have shown it into SOFP, and this goes to P&L. Now it goes to P&L under finance cost section, which you have. When you will calculate your finance cost, it will go to finance cost element. Okay, so this was one working which was done here. Then you have this loan agreement of 25 million. Okay, intra-group trading. Let's calculate intra-group trading as well. And administrative, I'm actually still going a little bit down, and I'll call this one as working 2, and this one I will call my working 3, intra-group trading. So whatever comes to mind immediately, intra-group sales were 10 million. Total profit. I don't need this actually. Let me call it unrealized profit. Unrealized profit, not intra-group trading. Unrealized profit. So I've got my closing inventory and I've got my opening inventory. And the difference in closing and opening inventory, 3 million. This is 2 million. So actually this is the difference. We say that difference in inventory, and within that you have unrealized profit. And how do you calculate that? What do they tell you? How much is that intra-group trading profit? Yeah, can you tell me please?
1/3 of markup.
Huh?
1/3.
1/3. So 1/3, you can actually show it in both ways. If you want, you can do it like this as well. For example, you can say that unrealized profit on closing inventory. Unrealized profit on closing inventory, and you should say 3 million into 33. 1/3 means 33.33%. 33.33 divided by 133.33. Like 25 divided by 125, if you remember the same logic. So 33% I'm taking. And then I take here 2000 into 33.33 divided by 133. Sorry?
25%.
Yeah, it's the same thing, but we are following the same logic, which is, so this is what you have intra-group. So this is your unrealized profit. This and unrealized profit, where I'm going to do, what I'm going to use it, unrealized profit has 2 in that. So the double entry is debit your group retained earning, credit inventory. Inventory, if you are making balance sheet, group inventory you will decrease. Otherwise, we are going to charge it to cost of sale. So we will add it into the cost of sale calculation. Without this one, we cannot do cost of sale calculation. What else goes to cost of sale? That impairment was like, remember that revaluation thing? So let me make that working as well so that I can make my cost of sale. Because they told me that revaluation of PPE, that impacts cost of sale. So I'm just actually focused at this point to complete my cost of sale. The last thing here in cost of sale was revaluation of property. It goes to cost of sale. So let's also calculate this thing. So how much is the revaluation gain? 5 million and 3 million. So I would say alpha's revaluation gain is 5 million. Beta's revaluation gain is, I think, 3 million. Total is 8 million. Out of that 8 million, previous losses were 3.5 million. It was given here that the losses made were 3.5 million. If you see here, I remember this thing because I read this thing 3 times. 3.5 million previous charges, and these must be now reversed back. These must be recovered. So this 3.5 million, I should say, reverse in cost of sale. So, and this adjustment, 4.5 million, that goes to adjustment in OCI. In OCI, will take only 4.5 million. 3.5 million I will transfer there. Now I'm ready to calculate my working number 5, which is cost of sale. I hope that there is nothing else. And I would say alphas cost of sale plus betas cost of sale less intra-group sales, add unrealized profit, and then okay, revaluation spellings are wrong. Then reversal of impairment. That's all, nothing else. So alpha's cost of sale was given here 26 million and 16 million. So I will take 26, 16, I think straight numbers, yeah. And intra-group trading less 10 million. Add back unrealized profit. Unrealized profit is only 250. I'll take it from here. And then this thing 3500, and I will so what should I do? This 3500, should I take it as minus or as a plus? Should I write down 3500 like this, or should I write down 3500 with minus sign? Please tell me.
Minus sign.
With minus sign, right? Why should I write it down with minus sign?
Because it will reduce the cost of sale.
Yes, because I want to reduce the cost of sale. In the absence of this, cost of sale was 32,000, but I'm going to decrease my cost because I'm making a gain. So it's a gain which I'm transferring, reversal of impairment, kind of a gain which I'm transferring. So that should decrease my cost of sale. So I take it with a negative sign and I will call it this is my group cost of sales. So I need this number with me. I need adjustment in OCI here. This number we already treated. This number we are going to take. This 2200 we will take as finance cost. Group revenue we need this much. So these are the numbers which we are going to use here. What else is remaining? Investment income. And investment income we should take as working number 6. Working number 6. So alphas, investment income. Then we have got betas, investment income. How much is that? I think 5 and 3, if I'm not mistaken. No, that was only 7. No, only alpha. There's no beta. So that was 7 million. And then I would say less intra-group dividend. How much was that? Total dividend was paid out by 5 million. Intra-group dividend, I think they showed somewhere here. Beta paid a dividend of 5 million. So beta is paying 5 million. We are only 90%. So 5 million into 0.9. This is what comes to us. I'll take this one here into -1. This I have to remove. What I'm doing. Okay. Huh? Not 50. Then there is intragroup interest. Interest on loan. Loan was given, I think, how much was loan? 25 million. 25 million of loan at 8%. This also must be removed. So this is actually, this will be removed from two sides. On one side, it is written as investors in income side of alpha, and finance cost of beta. So when you will make your, finance working number 7 would be your finance cost. This number you will have to remove again. So 25 million into 8%. Okay. So if I take it here and I put just an equals to sign into -1. So that 2 million actually will also be reflected in finance cost because I have to remove it from finance cost because beta was showing it as finance cost. So this I can say that investment income from other or other investment income. Let's call it like this, other investment income. Other investment income. But then there is one more thing which we need to pay attention to because they told us that there's something, a difference in fair value. 32 million and 33.5 million. This is related to alpha's investment. I would say that gain on fair value of investment portfolio. And that is actually 1.5 million. I will write down like this. So this goes into investment income. So investment income we have done. Now, these are very simple calculations. Finance cost, alpha, beta. Alpha has finance cost as 4 million and 2.5 million. So 4 million and 2.5 million, and intra-group interest, which is this one, and we will subtract this thing else from here. I think finance cost is nothing else other than that. So we get here our finance cost. Okay. Any questions until here? Please ask me, because I did quite a lot of calculations without getting your feedback. Working number 8 is share-based payment. So in share-based payment, let's read it now because we did not read it before. So we do this share-based payment thing. So let's read it together. It says on 1st April 2003, which means on the acquisition date, Alpha granted 500 senior executive 4,000 shares options each, like 2 years ago, because we are preparing for 31st March 2005. So 2 years ago, they made this option. Okay. The options vest on 31st March 2007. So how many years are there? You need to understand the total number of years because the cost would be like you have 400 people and to each person you are giving No, you have 500 people. I'm sorry, my pen is like bothering me a lot. I don't know. I need to configure it. 500 executive. Each executive will get 4,000 options. Okay. And that 4,000 option is at a certain price, but this cost is for the cost of the entire period. So how much is the total period? First, you understand. Starting from your 1st April 2003, 2004, 2005, 2006, 2007. So there is a 4 years commitment that you stay with us for 4 years, and we give you 4,000 options every one. Now, we are in the middle somewhere because we are preparing financial statements for 2005, which means 2 years after 2 years. We gave that option grant on 1st April 2003. We are preparing financial statements on 31st March 2005, which means that 2 years have passed. We are in the middle. So on 1st April 2003, Alpha granted 500 senior executives 4,000 share options each. The options vest on 31st March 2007. The options only vest for senior executives who remain employed by Alpha on 31st March 2007. The following information is relevant. On 1st April, fair value of option is 1.2. 31st March, it is 1.35. 31st March 2005, it is 1.5. Remember that these which you are giving, whenever you give share options price, you always take on the grant date. These two numbers are just to confuse you. We will only speak about 1.20. We always take it on the grant date when we talk about share options. Share options do not have a fair value on the current date because it is not cash settled. It is options. Cash settled, you take the current price. Options, take grant date, 1.20. So if I take this number now, if you remember the standard when we were doing it together, so how did we used to do it? We calculate first, like we say that, cost until 31st of March 2005. So on 31st March 2005, it is 450 executives we expect that they will receive. Everyone will receive 4,000 options, and each option is priced at 1.2. But if you calculate this thing, this is a cost for full 4 years. Now we are in the middle, which is this year 2. So we divide it with 2, multiply with 2, divide by 4, we say 2 by 4. When I take it 2 by 4, this is actually going to be the cost of 2 years, 2004 and 2005. First 2 year cost is this. Now, if you read here, it says, the transaction was correctly accounted for in the financial statement of Alpha for the year ended 31st March 2004, which means in the previous year, they calculated and they recorded it correctly, and the cost was recognized as the administrative expense. So this goes to administrative expense. However, no further entries have been made in the financial statements for the year ended 31st March 2005. So second year entries we did not make. So now this is for 2 years. We know that first year they already recorded it and they recorded it correctly. So in the previous year end, the estimate was not 450, the estimate was 420. This is how they did in last year. 420 was their estimate, multiplied by 4,000, multiplied by 1.2, and multiplied by 1 by 4 because they took 1 year cost. So this much of cost has already been recorded into -1. And by the way, I should divide because I'm taking 3 zeros on the top, and here I'm putting the full number. So I need to divide this thing entire with 1,000. Okay, so I'll divide it with 1,000 so that I don't get confusions with my zeros. I'm just converting it into the way we have done here because we have got 3 zeros on the top, and here I took full numbers 4,000 and 450. So this is actually the cost. This is the cost for the year. This is cost for the year 2005. This goes to my P&L, 576. It goes to my administrative expenses. Total cost for 2 years minus the cost which was already recognized in the last year. So this is the cost for current year 2005. Are we clear on this? Now I can make my admin expenses. Okay. So if I go back to admin, I will say what is alpha and how much is beta. And I think that nothing else goes to admin expenses because revaluation thing impairment went to cost of sale. So I only need to have this one here. And I would say that share-based payment, staff cost, adjustment, share options. So how much is alpha? Let me see. Alpha and beta, 9,000 and 3,500. By the way, I'm taking the full numbers because it is full 1 year consolidation. Because alpha beta was your subsidiary throughout the year. If you had done a mid-year acquisition, let's suppose you purchased alpha or you purchased acquired beta on during the year for 6 months, for example, on 1st of July or I don't know, 1st of October, whatever, then you need to proportionate the income statement first and then add. We discussed this thing before as well. But here it is a full year, so we are taking the full number. So how much is that? This is 576. This is going to be added. So this is your admin expenses. So once my numbers are now ready, I can now consolidate. I just remember now one mistake we made, or we forgot something to add. That is how to say, deferred consideration should come into my finance cost. Remember? We calculated deferred consideration. Where was deferred consideration? This 22. We said that we will add it into P&L in finance cost, 2.2 million, and we did not add here. This type of mistakes are common in exam, which you will make. So be aware of that. So here I would say deferred consideration, and write down the name of the working 2 or working 3, whatever it was. So take it up, and this was working number 2, deferred consideration. So your total now finance cost will be like this. Okay, it's something like this, 6.7 million. This 4, 2.5, intra-group interest 2 million, 2.2 this, 6,700 comes up there. Now we are ready to prepare our statement of comprehensive income now. It's a statement of comprehensive income for Alpha Group for the year ending 31st of March 2005. So our workings are ready. We'll just put it here revenue. I will put here cost of sale. Then it will give me gross profit. After gross profit, we have our admin expenses. We have distribution expenses. What else do we have line item? Distribution, admin, investment income, and finance. Investment income. I'm going to follow the same format. Okay. Investment income and finance cost. Investment income, finance cost. I will call it profit before tax. Then I will have my tax expense, and then I will call it profit after tax. I will charge here OCI, and then I will call it TCI. That's all. And then we will distribute this profit and OCI, TCI both part between the NCI, which is 10%, and the parent. But let's start putting the numbers. So revenue we did here 93,800. Cost of sales we take there. 28750 and I'll multiply it with -1 so that I get the number. I get gross profit here. Admin expenses we just made here 13, and let me put it with -1. Distribution expenses we did not make any adjustment, so we'll take the numbers from there. Distribution expenses were 5,000, 10,000, 7,000. So I'll write down 5,000 plus 2,000. Let me put it like straight away. Investment income we'll take from here. I did not make it yellow color. I should have made it yellow because otherwise I'll get confused. Which numbers? Then I have my administrative expenses. I treated this 576, so I don't need this 576. Okay. Finance cost I'll take from here 67 into -1, and this will be called my profit before tax. Tax expense, again, there is no adjustment for tax expense because there is no deferred tax or anything. They said ignore deferred tax, and throughout the notes they never told us that take impact of deferred tax or something. So tax expense I'll take straight away from here 7,000 and 4,000. So tax expense is 7,000 plus 4,000, which makes me 11,000. Oh, profit before tax is negative. Wait a minute. Sorry, this much only. 40, this much. So profit after tax. You've got any comments? Please make. OCI. What goes to OCI? Remember, adjustment to OCI was how much? 4,500 we did before. Something here. This 4,500 after taking some part into, because 35 we already took into cost of sale. So 4,500, and my TCI will be 33,743. Now, who sold goods? To whom the goods were sold? Parent sold goods to the subsidiary. And now what we need to do, that this is my profit and this is my TCI, and I would say that let me call it like profit attributed to non-controlling interest and profit attributed to the parent. Guys, am I doing it for myself or you people are with me? Maybe I'm doing practice, further practice. Yeah, any question until here, please ask. So we need to give NCI was actually 10%. So NCI was 10% of what? Am I going to give him 10% from this number? Should we give him 10% from 29,000? No. We should give him 10% from which number? From profit of beta. And we are giving it straight from the beta because there is no sale. Beta did not make any sale. So beta profit I'm taking as it is. There is no unrealized profit adjustment here. There is no other impairment of something. So beta, whatever beta profit is there, 11,000, we are accepting it as it is. So we are giving it from here. If there is some adjustment which is needed, for example, if beta had sold goods during the year, I would have subtracted that number, unrealized profit from here. If beta had some impairment, I would have subtracted that number, impairment of goodwill, etc. And then I should distribute. But because in this case, this profit is neat and clean 11,000, and I would give from this 11,000, I would say 10%, 11,000 into 10%. I'll take this number here, and this comes to 1100. It goes to NCI, and then I would say 29 minus this 1100. This goes to the parent. So this is how the profit is divided or distributed. And then I go to TCI. If I see the total comprehensive income, again I'll take the full number 14,000, and I'll take 10% and I'll give it to beta 14,000. So this is now here 14,000 into 10%. And then this 33,734 minus this 14,000, and that goes to the parent. So you divide or distribute the profit between the two and the total comprehensive between the two. Nothing else is needed. This is done. This question is solved. If you've got anything else to ask, please ask. And this is a question which I've taken from, like I said, September 2020. So that's quite a recent question. It's exam question from September 2020. It took us a little bit of time because we were discussing it. But if you're doing it alone in exam, it shouldn't be very difficult. You might make mistake in one or two things, but of course, whatever you will get correct, you will get your marks. So this is exactly exam style question. Yes, please ask.